General Electric beat Wall Street's estimates for profit, sales and cash flow in a strong first quarter. Now, these earnings give a temperature check ahead of General Electric's planned split. GE will break two separate companies, one focused on aviation, the other on energy in 2024. The company's aerospace division, which will eventually become GE Aerospace, had a strong first quarter. The franchise logged notable gains in revenue and profit. Guidance was also boosted thanks to a positive outlook for aerospace demand in the years to come. Now, the remaining portfolio of GE's energy businesses will be held under GE Vernova. It includes a large investment in clean energy. In the first quarter, GE's renewable energy sector saw significant growth in orders, but is still operating with negative margins. GE's healthcare division already split off earlier this year under the ticker GEHC. The company reported as an independent operation this quarter, beating estimates. Well, joining me now to discuss what GE's latest earnings mean ahead of its eventual split is John Eade, Argus Research President. Good to have you on the show, John. So first, obviously, we're looking ahead to, of course. So I want to first get your takeaways because in 2024, we're going to get this split between the power business and the aerospace business. How are you valuing each part of this business?
Well, they are two very different businesses, as you just illustrated. And the trends are different for them, too. The aerospace business is hot right now, and that's because Boeing is back to producing the 737 MAXs. That's because commercial air travel is returning to pre-pandemic levels. So these are great times right now for aerospace, and the business is reflecting that. The power business, though, is more of a turnaround. So I think I'm looking at aerospace as a growth business, although I don't expect it to grow this fast into 25, 26. And I'm looking at the power business, the Vernova, as a real value business and a turnaround opportunity.
And I do recall when you were on Yahoo Finance in 2021, you said that CEO Larry Culp inherited a train wreck. What are your thoughts then on his turnaround for this business?
Well, it's coming together, and I had thought it would come together faster than it has, but the pandemic got into the way, deglobalization and supply chain issues and inflation got into the way. But I do think the results that the company reported this morning are indicative that the turnaround is occurring. Like you said, there was revenue growth. There was margin improvement. The company turned cash flow positive, and that was very much a hallmark of Culp's days back at Danaher. And now the company is even buying back stock. It hasn't done that for a while. So it's still, I think, early where the turnaround isn't complete, but the progress is definitely there.
And so expectations for the upcoming split, I mean, obviously they're very different kinds of businesses, but even as we look at GE's healthcare business that had spun off in early 2023, that's gained about 31% year to date. What are your ideas on where you see the health business going versus some of the other aspects of GE?
So, the healthcare one was in great shape coming right out of the pandemic. Remember, the aerospace took a little bit longer to come around. But healthcare was shiny. They spun it off. They sent it out at a discount to other healthcare companies. The price to sales ratio was lower. The price to earnings ratio was lower. So as people have gotten to understand that business, I think as a standalone business, it has performed well in the market as it's moved up to more normal healthcare valuation levels.
And a part of the business that hasn't posted as well in terms of operating losses, it's renewable energy side of the business. What do you think are the biggest issues that GE is having in growing that business? And at what point do you think it will become profitable?
I think that's probably their newest business. Not like it's brand new, but it's still relatively young. And if you look at the revenue composition, they're selling a lot of equipment when they do sell, right? Orders were up 94% this quarter. So it's very volatile on the orders. But remember, the real profit comes in not on the equipment sales, but on the service contracts that they sign once the equipment gets into place. So they're still selling a lot more equipment. And as that equipment is established and then GE starts to service that business, I think that's when you're going to see the more consistent profitability. And I'd put that out 2 or 3 years from here.
And so then what do you see as the biggest risks for that side of the business as it's emerging?
Well, you and I have just been talking about the income statement here. We haven't seen what GE is going to do yet with the balance sheet. My thinking is that they'll probably have aerospace come out pretty lean on debt levels, and they may saddle the Vernova business with higher levels of debt. And if interest rates are still on the high side, that's going to cut into margins and cash flow. So I'm going to, I guess, reserve final judgment until I see those details of the balance sheet announced.
Certainly be keeping an eye on that. We'll be tracking that as well. A big thank you to John Eade, Argus Research President. Thank you for your time today.